Financial ratios are powerful tools that provide insights into a company's financial health. By analyzing these ratios, investors can assess a company's performance, profitability, and financial stability. Think of them as vital signs for a business, helping us understand its overall well-being. Understanding these ratios is crucial for making informed investment decisions. These ratios help us understand how efficiently a company manages its resources, generates profits, and handles its debts. They provide a standardized way to compare different companies within the same industry. Financial ratios are calculated using information from a company's financial statements. By analyzing these statements, we can uncover valuable insights into a company's strengths and weaknesses. When evaluating a company, it's essential to look beyond the surface and delve into its financial ratios. This will give you a more comprehensive understanding of its true value and potential. Liquidity ratios measure a company's ability to meet its short-term obligations. Two key liquidity ratios are the current ratio and the quick ratio. The current ratio is calculated by dividing current assets by current liabilities. It indicates how many times a company can cover its current liabilities with its current assets. A higher current ratio generally suggests better short-term financial health. The quick ratio, also known as the acid test ratio, is a more conservative measure of liquidity. It excludes inventory from current assets, as inventory may not be easily converted to cash. The quick ratio is calculated by dividing quick assets, which are current assets minus inventory, by current liabilities. A higher quick ratio indicates a stronger ability to meet immediate obligations. A company with a healthy liquidity position can comfortably handle unexpected expenses or downturns in the market. Conversely, a company with low liquidity may struggle to meet its obligations, potentially leading to financial distress. Profitability ratios assess a company's ability to generate profits from its operations. Two important profitability ratios are the gross profit margin and the return on equity, or ROE. The gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold, or COGS. It is calculated by dividing gross profit by revenue. A higher gross profit margin indicates that a company is effectively managing its production costs. Return on equity, ROE, measures the profitability of a company's equity investments. It is calculated by dividing net income by shareholders' equity. ROE reflects how effectively a company uses its shareholders' investments to generate profits. Profitability ratios are crucial for evaluating a company's earning potential and its ability to create value for shareholders. By analyzing these ratios, investors can gain insights into a company's pricing strategies, cost management, and overall operating efficiency. Leverage ratios measure the extent to which a company uses debt to finance its operations. Two key leverage ratios are the debt-to-equity ratio and the interest coverage ratio. The debt-to-equity ratio compares a company's total debt to its shareholders' equity. It is calculated by dividing total debt by shareholders' equity. A higher debt-to-equity ratio indicates that a company relies more heavily on debt financing. The interest coverage ratio measures a company's ability to meet its interest obligations. It is calculated by dividing earnings before interest and taxes, or EBIT, by interest expense. A higher interest coverage ratio suggests a stronger ability to cover interest payments. Leverage ratios help investors assess the level of financial risk associated with a company's capital structure. This information is crucial for making informed investment decisions. Efficiency ratios measure how effectively a company utilizes its assets to generate revenue. Two important efficiency ratios are inventory turnover and accounts receivable turnover. Inventory turnover measures how quickly a company sells its inventory. It is calculated by dividing the cost of goods sold by average inventory. A higher inventory turnover suggests that a company is efficiently managing its inventory and minimizing storage costs. Accounts receivable turnover measures how quickly a company collects its receivables. It is calculated by dividing net credit sales by average accounts receivable. A higher accounts receivable turnover suggests that a company is effectively managing its credit policies and collecting payments promptly. Efficiency ratios are essential for evaluating a company's operational efficiency and its ability to generate assets. By analyzing these ratios, investors can identify potential areas of improvement and assess a company's overall performance. Valuation ratios assess the relative value of a company's stock. Common ratios include the price-to-earnings, PE, and price-to-book, PB ratios. The PE ratio compares stock price to earnings per share. A higher PE may indicate investor optimism. The PB ratio compares market cap to book value. A lower PB may suggest undervaluation. Use these ratios with other metrics for a holistic view. Interpreting financial ratios effectively requires comparing them to industry benchmarks and analyzing trends over time. Comparing a company's ratios to its industry peers provides context and helps identify strengths and weaknesses. Trend analysis reveals how a company's financial performance has changed over time. Industry benchmarks provide a standard against which a company's performance can be measured. By comparing a company's ratios to its industry averages, investors can identify areas where the company excels or lags behind its competitors. Trend analysis involves examining a company's financial ratios over several periods. This helps identify patterns and trends in the company's performance. Comparing ratios to industry benchmarks and analyzing trends over time provides a deeper understanding of a company's financial health and performance. These techniques help investors make more informed investment decisions by providing context and revealing patterns that might not be apparent from looking at individual ratios in isolation. This information is crucial for making informed investment decisions. Financial ratios are most effective when used in combination to provide a holistic view of company performance. Analyzing ratios in isolation can be misleading. It's essential to consider the interrelationships between different ratios and to integrate qualitative factors into the analysis. This comprehensive approach provides a more complete picture of a company's financial health. For example, a company with a high debt-to-equity ratio may appear risky. However, if the company also has a high interest coverage ratio and strong cash flow, the risk may be mitigated. Similarly, a company with a low PE ratio may seem like a bargain. However, if the company's earnings are declining, the low PE ratio may be justified. By integrating qualitative factors such as management quality, industry trends, and competitive landscape into the analysis, investors can develop a more nuanced and comprehensive view of a company's prospects. This holistic approach is crucial for making sound investment decisions. While financial ratios are valuable tools, they have limitations. Ratios are based on historical data, which may not be indicative of future performance. Different accounting methods can affect ratio calculations, making comparisons between companies challenging. Furthermore, ratios alone cannot provide a complete picture of a company's financial health. Historical data can be influenced by various factors, such as economic conditions, industry trends, and company-specific events. These factors may not persist in the future, making it crucial to consider the company's current operating environment and future prospects when interpreting ratios. Different accounting methods can lead to variations in ratio calculations. It's essential to be aware of these differences when comparing companies using financial ratios. Financial ratios provide insights into a company's past performance, but they don't predict the future. It's essential to use financial ratios in conjunction with other analytical tools and qualitative factors to gain a more comprehensive understanding of a company's financial health and prospects. Financial ratios have numerous real-world applications for investment decisions. Investors use ratios to screen potential investments, compare companies within an industry, and evaluate the performance of their existing holdings. Financial analysts use ratios to develop valuation models and make investment recommendations. Lenders use ratios to assess creditworthiness and make lending decisions. Investors can use ratios to screen potential investments by setting thresholds for specific ratios. For example, an investor may look for companies with a current ratio above a certain level to ensure adequate liquidity. They may also screen for companies with a high return on equity to identify profitable investments. By comparing ratios across companies within the same industry, investors can identify companies that are outperforming or underperforming their peers. Financial ratios are essential tools for making informed investment decisions. By using ratios effectively, investors can improve their chances of achieving their investment goals. Financial ratios unlock valuable insights into a company's financial health and performance. They help investors make informed decisions. Ratios provide a framework for analyzing companies and comparing them to industry benchmarks. Mastering financial ratios gives a deeper understanding of a company's position and risk. This knowledge empowers better capital allocation. Integrating ratio analysis improves investment success.